In this discussion, and indeed in this chapter, we're going to think about accounting for merchandising operations. A merchandiser, and Walmart's the classic example of one, everybody's somewhat familiar with them, buys items and resells them. The merchandiser doesn't make anything, but on the other hand, the merchandiser is selling goods, it's not selling services. So let's imagine a transaction where a merchandiser buys merchandise inventory on June 1st. So the transaction they would record is a debit to merchandise inventory, which is a current asset, for $5,000. And they would show a credit to accounts payable, a liability for $5,000. I've written you this red asterisk that says, unless it's ever noted differently, this credit is to accounts payable and not cash. Walmart doesn't pay cash up front for its inventory. Indeed, Kmart filed bankruptcy in the year 2002, and the biggest reason it did it is because it got late paying suppliers, and when it did, the suppliers started making them pay cash for merchandise. Well, Walmart didn't have to pay until they sold the merchandise. When Kmart had to start paying when it bought the merchandise, it was immediately in trouble. Therefore, unless you're otherwise told, be comfortable that the credit when purchasing inventory is going to be accounts payable. One of the things we want to talk about is in this situation where the company has purchased inventory, what might happen if the purchase needed to be returned, if the inventory had to be returned. Now in this case, it would mean the merchandise was sent back. Or what would happen in the case of an allowance where the merchandise is kept? Well, in either situation with regard to a purchase, the entry is the same. We're going to debit accounts payable $400 and credit merchandise inventory $400. Now, when we get to sales returns and sales allowances, as one of the last topics in this video, we're going to see that a return and an allowance are handled by different journal entries. One thing that's very unique about a merchandiser is that when a sale occurs or when revenue occurs, two entries are necessary. Remember, in the early chapters of the book, when we sold our legal services or consulting services or something like this, we simply debited accounts receivable, credited sales. And that's all we needed to do. Actually, we called sales then consulting revenue, fees, income, something like that. But here, we're going to have to both record the sale and remove the item from our inventory. And notice that's what these two entries do. So in the first entry, we debit accounts receivable $1,000 if that was the sale price, and we credit sales $1,000 if that was the sale price. This causes assets, in this case promises or accounts receivable, to go up $1,000, and it causes sales revenue to go up $1,000. Also notice on the same day, there's a debit to cost of goods sold, and that debit to cost of goods sold is only $600. The credit is to merchandise inventory, and it's only for $600. In the next chapter, we're going to talk a little bit about how accountants really figure out the cost of the merchandise that's been sold. But in this chapter, what I call the accounting fairies give it to you. You might see them as the authors of the book. Just somebody else besides you, the accountant, goes through and figures out what the cost of the sold merchandise was, and you have an amount to put on your journal entry. Now I want to caution you, as I say at the bottom of this slide, these corresponding entries should never be the same dollar amount. Notice here, the first entry is $1,000, the sale, and the second entry, the removal of inventory, is $600. I tell people in face-to-face classes, if these are the same, the company's run by idiots. And if they're the same and the company's not run by idiots, then you've made an accounting mistake. The reason that these people would be idiots in this case is there are more expenses, as you'll see later on in this video, than just the cost of the merchandise. So if Walmart tried to give you cost price for certain items, who would pay the utility bill? Who would pay the salaries of the Walmart customers? The Walmart associates, and so on. In this slide, I'm providing you a sample of a manufacturer's balance sheet. So notice here that the merchandiser is going to have current assets like sales, accounts receivable, and merchandise inventory. It's going to have long-term assets like equipment, which of course will be netted against, or I should say, accumulated depreciation will be netted against it. And then we'll add up the current and the long term, and we'll arrive at total assets. The merchandiser's liability and equity section looks exactly like any of the businesses that we looked at in the earlier part of the course. Current liabilities plus long-term liabilities brings us total liabilities, and then equity. And total liabilities plus total equity has to equal total assets. Notice then the red on this page shows you the one new account, merchandise inventory. I didn't mark this one in red, but this is the income statement. And notice that on the income statement, there are a few new accounts. First of all, the name of the revenue account changes. It might have been consulting revenue or fees earned or something like that before, but now on a merchandiser's income statement, it's sales. Second, we now have our first expense above the line. So we now have sales or revenue minus cost of goods sold. And when we look at the sales minus cost of goods sold, we arrive at a new item on the income statement called gross profit. We're interested. These numbers should not equal 100 minus 100 is 0. Because if they did, look what happens when we subtract the operating expenses. We have a loss. So we want to see that the company had some gross profit, and then we're going to subtract the operating expenses that you're used to from the first few chapters. And I've just put some examples up here: salaries, supplies, depreciation. And so after you subtract the total operating expenses, they still have a net income, but indeed it's much smaller. Let's consider a few merchandising special topics. The first one is how to handle discounts. And really, the first one is just how are discounts shown and what do they mean? So you might see a discount, in this case a cash discount, written as 2/10, N/30. If you saw something like this, the 2 means there's a 2% discount. The 10 means it applies if the merchandise is paid for in cash in 10 days. The N30 means you have, or the buyer has 30 days to pay this before they're late. So to summarize then, if they pay quickly in 10 days, there's a 2% discount. If they pay in the normal time, they have 30 days. So what would happen if a business actually paid the discount? So, or I should say they pay, and then they take the discount after they pay. Well, here's the way that would work. We're going to go back to the example we did long ago on page 2, where we purchased $5,000 worth of inventory. So we had a $5,000 account payable then. On page 3, which I didn't necessarily relate at the time, but let's imagine they're related, we took a $400 purchase allowance. We sent, really maybe complained about the merchandise. The seller didn't want to take the merchandise back, but they gave us a $400 purchase allowance, and so now we only have an account payable of $4,600. Well, if we pay on June 10th, which is the 9th day, so it's within the 10 days, then we get a discount of $92, and I show you at the bottom how that's computed. 4,600 times 2% is 92. We always have to remove any account payable that's left. So we had $4,600 in accounts payable after the first few transactions. If we didn't show that all being debited off, it would seem like we still had a net accounts payable, and we don't. We show the merchandise inventory being reduced by the $92. This is because way back in Chapter 1, we talked about how assets are recorded at cost. If it turns out that we're actually paying less for the items, then we adjust the merchandise inventory and show the lower cost, which is what we actually paid. And finally, cash is the credit for the new amount that's due, which is $4,600 minus 92, or $4,508. Special topic number 3. What if we were the seller on the last page instead of the buyer? Well, if we were the seller, if we were the one offering the cash discount because we wanted to receive cash early, we would show the cash coming in as a debit for $4,508. Notice that's an asset going up. We'd show a sales discount of $92. That'd be offset against our sales, showing net sales is lower than gross sales. And then we would show our full account receivable coming off the books at $4,600 as a credit. The last special topic is what happens if we're a seller and our buyer wants to return items. Well, it depends on if we actually make them return them or if we let the customers keep the merchandise. So the top example I have, the allowance, we're letting our customer keep the merchandise. And in this case, we debit sales returns and allowances, which lowers sales, and we credit accounts receivable, showing that we're owed less money from our customer. So notice that under the return, the same initial transaction happens. We debit sales returns and allowances, credit accounts receivable. But in this case, we're also bringing merchandise back in. And so yes, just as before, we have to know the cost price of the merchandise. And when we know it, we bring merchandise back in with a debit to merchandise inventory. And we show a cost of goods sold expense going down because the inventory is returned. We do this second entry even if ultimately we're going to return these items back to who we got them from. We first still need to bring them into our inventory. All right, this is Accounting for Merchandising. Let me know if you have any questions.